Okay, let's finish part 3. We'll continue, at least initially here, talk about some more different types of stocks. You'll hear people sometimes refer to speculative stocks or speculative issues. These are stocks that, by their own description, I guess, are very risky. They're fairly unstable. They could have some substantial price appreciation. Most of these stocks are really related to emerging industries or emerging companies or countries even. So they're companies that don't have a lot of history. So since there's some uncertainty, they're obviously rather high-risk stocks. And of course, you can see some of the stocks, the examples that they identify as being speculative stocks. Cyclical stocks are stocks that typically go very closely with the market. If you can predict the stock market, then you have a pretty good prediction of where these stocks are going to go. So they follow the business cycle. So when we're moving into an expansionary phase, these stocks will follow that expansion. If you're willing to make some trades and be able to move in and out of some investments, these are the types of investments you'll typically have. You want to buy them when the economy is at its worst, and then you want to sell them when the economy gets to its best. Obviously, then you'll be buying low and selling high. Defensive stocks, again, tend to hold their value, and they do well regardless really of the economy. And again, think about those industries that people need just for survival, right? Electricity, beverages, food and drugs, right? These are all staples, are things that people absolutely need and want. So if you're looking for a place to buy and hold, that is, put your money somewhere and just let it sit there for a while, these are obviously going to be very good kinds of stocks, especially if the economy might be slowing. Because even though they may lose a little bit of value, they're not going to lose as much value as maybe some cyclical or speculative types of stocks. We talked about this a little bit earlier, market capitalization. And here's where they give us, a little bit of a definition of what that means. If a company has more than $10 billion in market cap, that is, you take the shares that are available, multiply it by the stock price, that's what you would refer to as being a large cap stock. Small cap stocks have less than $2 billion. So again, really we're talking about size here. So if you want stability, if you want to find something that's been around for a while, that has a history that you can watch, you probably want to steer away from small cap stocks. You want to move to large cap stocks. So what kinds of companies are these large cap stocks, right? It's going to be a great deal of companies, right, that fit this, right? It's not, again, they say here, bigger is not necessarily better, but they do tend to have less volatility. They do tend to produce when the economy produces. So big companies like Walmart, Exxon, Apple, these are all large cap stocks. Mid-cap stocks, right? They have long-term track records. Sometimes they refer to these as baby blues, right? They act an awful lot like blue chip stocks, but they're just not quite as big as the blue chip stocks. Again, we have companies like Logitech, American Eagle, Garmin Limited. All of these stocks could be classified as small cap stocks or as mid-cap stocks. Small cap, obviously, these are the smallest. They don't have a financial record. They're going to be much riskier. They're just brand new kinds of companies. If it's a real new company, maybe even liquidity might be an issue if it's real small. So again, some of these companies, Callaway's, Wendy's, Shoe Carnival, all of these can be classified more as small cap stocks. All right, what about investing in foreign stocks, right? I mean, the United States market represents 35% of the world's equity. That must mean there's 65% out there that we would like to invest in. 6 countries make up 80% of the entire equity market. Again, we have the largest market, and 35% is the largest piece. But again, there are some other companies out there, countries that have equity markets that are efficient. Information is easy to get. Investing in those types of companies and those types of countries even is actually fairly simple sometimes. There's 3 basic ways you can buy global. You can buy directly in foreign markets. The challenge with this is currency. You have to worry about tax problems, etc. So you probably, if you want to invest globally, actually going to the foreign market and buying securities is probably not what you really want to do. You could buy what are referred to as ADSs, or American Depository Receipts. Simply, these are bought by banks. A bank buys the stock, and then you buy a receipt from the share from the company. So the transactions for these are all in United States dollars. So you don't have to worry about currency. You don't have to worry about foreign tax issues. Everything is done within United States. And then on the end of the last opportunity, which I personally think is the best of all the opportunities, is actually to buy international mutual funds. These are mutual funds that by definition they're international. So if they're international, that must mean they don't invest in United States stocks. So an international mutual fund will not have any stocks from within the United States, from domestic companies in the United States. If you were to buy a global mutual fund, since the United States is part of the globe, then there would be United States stocks. And since there is such a high number of United States equities out there relative to the rest of the world, you're probably going to get a substantial amount of domestic stocks. So your diversification or your risk reduction might be less. International investing is obviously more complex, right? Not only do you have to pick the right stock, you have to pick the right market, you also have to be able to understand what's going to happen to currency. That's the biggest and the most difficult issue, is to understand how currency is going to change. Here's the issue as I see it with currency exchange. If the world were a true market world and things were just left to change as the marketplace changed them, right, as market forces change securities to change, then I wouldn't be as concerned. You get what you get, and there is some risk, but in the foreign world, frequently countries will manage their currency. As of late, China, Japan, all of these countries have been managing their currency so that they can increase their economies. They want to build stuff and sell stuff, so they need to make it cheaper. So they reduce the value of their currency to the dollar. So that means we want to buy more of their stuff. The challenge is then that drains money from us towards them. It helps their economy, but it doesn't necessarily help our economy. So again, how do you find a return on an international investment, right? A stronger dollar has a negative impact on foreign investments. weaker dollars have positive impacts. So if you take current income and dividends plus the capital gains, and then you have to apply the changes in currency exchange in order to understand the total return in US dollars. So now that the US dollar is stronger relative to everything else, their goods are cheaper, but that has a negative impact on foreign investment, right? That means that their value of their currency is going down, so the value of that asset is ultimately being negatively impacted. So what are some strategies? Why would you want to invest at all? There are really three reasons why anybody wants to invest. You want to store and save some money, right? So you're looking for safety as a primary goal. So you're going to use high quality, blue chip types of stock, non-speculative stocks. In fact, if you're really looking for a storehouse in value and you're really concerned about safety, you might also consider bonds in addition to some stocks. You might want to accumulate capital, grow your wealth. Again, growth-oriented stocks are geared towards this. And of course, the exact same thing is true of investing for income. You want a dependable flow of dividends. As an investor, as you're growing, you probably want both of the. Obviously, you want to store value. You want to grow wealth. You want there to be some safety. But there is obviously some risk involved with the stock market. But you probably would like to find companies that have stable dividend payouts and also have the potential for stable, continual types of capital growth. You may have heard people talk about this. I mentioned a little bit earlier. There's something referred to as the buy and hold strategy. Again, here's where people want to buy stocks. They want to hold them for extended periods. This really relates almost directly to the storehouse of value, right? It's a conservative approach. You're really looking at trying to identify value stocks. We'll talk about these a little bit later on, what the definition of a value stock is. Current income, all right? We're looking for high dividend yields. We're looking for safety of principal and stability of income. Sometimes we may prefer this to bonds because dividend levels tend to increase over time while bonds don't. In addition, dividends do have a lower tax rate than bonds have. Quality long-term growth, obviously, it kind of defines itself here. Capital gains are the primary goal. Since we're moving from dividends to capital gains, there is a little bit more risk. But again, since we're looking for quality here, we're going to be looking for well-known companies that have been around for a long time that have stability. If you're looking for aggressive stock management, again, we're looking for these growth opportunities, but we're really going to be looking more towards your speculative kinds of issues or things that have more volatility with them. So we're going to be moving from larger stocks to a little bit more mid-cap, a little bit more cyclical kinds of stocks. Obviously, there is a lot of time that you need to input into this particular strategy because you have to be careful of what happens to the markets and where things are moving. Speculative is short-term trading. Sometimes referred to this as day trading. I mean, day trading by definition is frequent trades, almost exclusively on very low priced stocks. So you may buy $2,000 worth of a 10-cent stock. So you have whatever that turns out to be. You know, you now have 20,000 shares of this stock. So if the This stock that costs 10 cents, if it goes up a penny, then you got 20,000 times a penny. The amount of return is relatively high because the stocks have such a low price. But it's high risk, and in the end, it's obviously very time consuming because by definition it's day trading. You have to do this all day long. But there's also a lot of trading costs since you're buying, selling stocks frequently. And frequently, if you look at stock returns, what countries tend to have the highest returns? It looks like here Finland and South Africa typically have the highest returns. The United States is in the middle here, around 9.3. And if you look at most of the other companies, we're all pretty close here. Denmark, Canada, United States, United Kingdom, until we get to Italy is 10% or more, right? Those are all pretty decent rates of returns over this 111-year time frame.